and it has started. So officially, it is April 10th, 2025, and this is the Market Structure Edge live demo discussion. I'm Tim Quast, with me Brian Wilson, and thank you all for being here today. So I'm going to go first, I think. Candace, nice to see you. Hi there. So I've got basically four things to cover, and I think Brian's got five in our pre-event confab, and I'll go first because I've been gone. So I will. In fact, I'll do this. If you will bear with me, I will share this. You may not care, so this could be a waste of time. but I thought I would. I'll show you life on a boat. I think this is our 15th time taking a boat out. We belong to a club that owns a bunch of boats in several locations, and so this is what we do. That's me feeding the birds. I love to do that. So the birds are incredible. They will, I can stand back there and hold something up, and here they come, and they catch stuff live on the fly. So this is our 72-foot catamaran, and this is in St. Vincent and the Grenadines. So we had 8 of our friends along. There was a junior, one of the crew of 3. We had a captain, chef, the chef's first mate. So crew of 3 on this boat, and do not let this get out. But this is life on the boat, right? This is what you're doing. This is in the Tobago Keys, which is a really beautiful part of the Grenadines. If you haven't been there, just beautiful water. It's where a bunch of Pirates of the Caribbean was filmed. So they still have the sets. The place where the pirates were hanged, that is an arch right off of St. Vincent. But it's just a beautiful place to go. So anyway, I thought I'd show you. St. Vincent is like a rainforest. It is spectacular. Waterfalls everywhere. And this is what it's like. So if you have the chance, go do it. It's great. It's great fun.
So Tim, before we leave the topic of vacations, I don't know if everyone noticed, but there's basically a Quast put that's in play. When the Quasts go on vacation, we can kind of bet on the market declining. And I don't know if you noticed, I was at a conference yesterday, and the market went higher. So I don't know if there's a correlation between the two. Maybe I should be on vacation a little more often. I'm not sure, Tim. Just tossing it out there.
Right, yeah. The Quast vacation put. By the way, we have a trip to Tahiti. We're going to do this. I think it's right at the end of August. Brian doesn't even know that. So probably you want to sell and short the market. Anyway, so let's. The first topic that I've got is the importance of market structure. And look, there's nothing. There's no data set that's going to tell you about massive outlier edge cases like we had yesterday. I will talk about, both of us are going to talk a little bit about volatility. I am not going to sit here and say, well, we could predict these kinds of things. No, you can't. No one can do that. But it sure reminds, I was telling Brian, I am grateful to be basically dead level, where I was March 25th. I mean, to me, it's fairly easy when you understand demand, supply, and volatility to make money trading. But in situations like that, if you're long short the market, you could get absolutely destroyed. And people did. I have no doubt that when you have them, and I had things that moved unbelievably. And I came out dead level. That's today. With the market down sharply today, way up yesterday, sharply up, I am basically where I was March 25th, and I consider that a victory. I was profoundly grateful to God for that, because there are times when there's nothing you can do. However, you are in a much, much better position if you understand market structure, jargon term that means the mechanics and rules of the stock market, and our data are predicated on that. They're not predicated on technical signals, fundamentals. They're predicated on the buying and selling under the regulations of the market. Right? We call them Rule 605, 606. How you route and execute trades in the marketplace are things that have to be tracked. and all trades have to occur between the best bid to buy and offer to sell. I've explained often about the what we call the 1-2-3 principle. That generally speaking, SPY, which Brian's going to talk about, the only ETF we have on the platform here because it's very useful to understand, and it went to 1. Even as the market went up. So how's that possible? It takes an average. I mean, it's taking a read. One day is not a pattern. But the 1-2-3 principle is SPY moves 1% under ordinary conditions, just rounding it off. The underlying basket of stocks moves 2%. And you say, well, why? How could that be? Well, because SPY doesn't move as much as the basket. And that's why Citadel, Jane Street, Susquehanna, Hudson River Trading, all the proprietary traders who are making markets in the basket and the ETFs are basically guaranteed under predictable conditions a profit. And the SEC cedes that profit to them because they make markets and everything. I mean, I could sell $50,000, $75,000 of a position at a time. Now it'll be split into many, many different transactions, but the reason you can do that instantaneously is because the SEC has permitted Citadel et al., I'm just using them as a case point, to not have to locate shares to short. They can manufacture stock to fill orders. So if I'm buying, my trade instantly fills. If I'm selling, it instantly fills. Why would they do that? It's not active, it's not some other person on the other side of my trade. And it won't be for most of us because most retail order flow is sold to a wholesaler like Citadel, Virtu, Jane Street, Two Sigma is in that business. UBS is in that business. And so that's how the market works. Knowing that is very important because you understand how prices are set. And so you put continuing. The three in that equation is momentum. Stocks that have demand supply imbalances move 3% or more. So it's the way that we make money. If we know what the market is likely to do and what the basket is likely to do and where the momentum is, where the demand supply imbalances are, we just take advantage of those. It's probabilities. Everything is a probability ultimately. And say, well, isn't that just gambling? Well, no, your gambling uses probabilities. Everything business. The business, running a business is a probability outcome. And what is the probability you can sell a product and your expenses related to doing that and providing a service are less than what you can generate? It's still a probability game, right? So that principle has broken. And how does it get fixed? Who suffered from that? I don't know. I can tell you exactly why this occurred. And you say, well, Tim, it's because Scott Bessent came out and said, well, we're going to suspend tariffs for 90 days. That doesn't buy and sell stocks. Machines buy and sell stocks. Machines read everything. People do too. But if you look at the data, which we do, and by the way, this data that I'm showing you on my screen, these weird little colorful bars, this is what's behind. And you say, well, why wouldn't you put this on the Edge platform? It's not meaningful in terms of helping you decide how to buy and sell things. What you use to buy and sell should be as simple as possible. Demand and supply and how much prices move, very simple. The things that cause demand and supply are all of these. Here's yesterday. This is how much prices closed over the midpoint. I mean, it's staggering. And if you look at the behaviors that were responsible, the blue bar, which is down, is rational thought, is active money, is the kind of money that would go, oh, well, that's really good news. I should buy stocks. That didn't happen. That's not what did it. It's machines and everybody rushing to the same side of the boat. Now think about what happens under those conditions. 90% of volume in the market is a form of trading a basket, trading ETFs, and trading derivatives, options and futures. They all have them. They're exchange traded funds. There's an underlying basket. Those two things need to track each other predictably or you get in trouble. If things move apart, the regulators will fine you because you're not providing what your prospectus says you provide. So who's going to do that? Who's going to make sure that an ETF tracks a basket of stocks? Somebody motivated to make money. Citadel is guaranteed a return if the basket's moving more than the ETF. And so this is what happens throughout the day. Say the ETF, there's more demand for the ETF than the basket, and they separate. So then market makers are going to short the ETF and buy the basket. And then if the basket rises over the ETF, they're going to short the basket and buy the ETF. This goes on all day until you get to the reference price in the last 10 minutes, which is why I trade then often. I know I'm going to get whatever the balance is, right? It's the best place to be, because the rest of the time you can be victimized by all of the arbitrage. Now add in options. Options are derived from both. ETF, there are options to trade on ETFs. ETFs are trying to track a benchmark, could be the basket. Well, let's say it's the S&P 500. That's a futures contract, right? And then there are options on that futures contract. There are options on all the underlying stocks, right? So all of that stuff has to behave in some predictable mathematical way for prices to remain stable. And when you have events like this, look, I don't know what's going to happen. I can tell you that when we looked at the data, and I shared some of this with you before, and you don't have to know everything that's here. Just realize that effectively we're tracking how much prices rose and fell. And this is over a long period of time. It's 2017. So, cycles in the market tended to run fairly short before the pandemic. This would be a cycle, where stocks rise. The yellow thing is demand, it's sentiment. And you have a short cycle. Then you have a really big one here. Then we elongated that cycle and it broke down. But it begins with signals. Well, we got that. If you ran a mathematical analysis of this, which is I shared with you, I said, if you ran a mathematical analysis, this will be worse than that. Why? Well, because the beginnings of it are much larger than the beginnings of these other ones. And we had the largest volatility event ever, so far as I can tell, in SPY December 18. Shared that with you. If you look at the volatility of volatility, you look at SPY's movement on the 17th versus the 18th, it's the greatest movement it ever manifested in the data set, so far as I can tell. And so you would look at that and say, well, it could mean we have an unbelievable volatility event coming. I don't know, but we've had it, haven't we? And so, if you look at the volatility now, here's the volatility of the S&P 500, the underlying stocks. This is even above the average. So it averages about 2.2%. If you want to be precise, I just say 2, round it to 2. Well, the 200-day average is 2.4%. Look at the 5-day average, 7.5%. Well, what's the market doing? I mean, you could look at it and say, well, if it goes from 3.7 to 7.5, 20 to 5-day, probably volatility is going to get larger. And son of a gun, it did. And it can be up and down. And the comparisons to, whenever they say, well, this is the biggest, the largest move since 2008, that should trouble us, right? Those kind of conditions that's not good. When the market goes up double digits, it should not do that because things will break. If you're trading a leveraged instrument, I don't know if you saw these things. I mean, some of these things moved today, even. Today, UVIX had some of that, was up 56%. And I look at that and think, it could go broke. I mean, you get a movement like that. So how those things work is there's the provider of the instrument contracts with someone, Goldman Sachs, to create a basket of derivatives that will deliver a 3 times levered return on volatility. In that case, I guess it's 1.5 on that particular instrument. UVI 1.5 times the VIX. Well, what happens if you have to cover that? And I don't know who in that equation, wins and loses. I mean, if you owned it and went up 56%, well, you made a bunch of money, but somebody has to deliver that. Now, Goldman Sachs is very good at farming that risk out to somebody else. I don't know who. And I'm not I'm not a genius on these things. I'm just saying that common sense would tell you when things move so dramatically outside of the parameters that the market is meant to accommodate, and how this whole ecosystem works, somebody will go broke. And Jeff Gundlach, the bond king, we've got his double line funds, and he said, you look at this, and probably somebody went broke. Remember, Credit Suisse basically was forced into the deal with UBS because of the failure of Archegos Capital, leveraged hedge fund. It had big short positions, levered 8 or 9 times via derivatives in a basket of stocks that went up. And it caused the fund to fail. So, I don't know what's going to happen. What I'm telling you is that things like this are abnormal and they break market structure. And it's important to understand that. So then how do you use this to your advantage? Well, you got to be really careful here, because now we're outside the predictable parameters. Look at this. There are no choices in low volatility because nothing fitting the parameters manifests low volatility right now. I mean, it's that serious. There's nothing in momentum, and yet we've had huge momentum, right? Well, it's because nothing is predictable. And when nothing is predictable, be very careful. If I look at the broad market, you say it's below 4.0, the market always rises from that level. Would I potentially buy a long position today? Maybe, but you got to be really careful. I mean, I'm certainly not buying any leveraged instruments when volatility like this. I use them all the time. But when volatility is way outside the parameters like this, don't chase it. I mean, you could just get destroyed. And that there are times when you just take a long step back and say, I'm going to wait for predictability to return, because if you can't calculate probabilities, it's telling you something. I can't tell you what UVIX is going to do. So then if I'm going to trade something that I can't tell you what it's going to do, then I'm gambling, right? That doesn't make any sense. So those are, I think I have covered all 4 of my points there, and I want to make sure to cede plenty of time to. I'm just going to check. Oh, I did want to tell you about this, and feel free to ask questions. We don't know everything, but we do know a lot about market structure, and it's not mystifying to us. We don't sit and think, oh, active money is doing this, or the market's way up, market's way. We know what is doing that. I think that alone is important. But I wanted to give you an update on the portfolio. I shared with you that we're going to put a portfolio, an edge portfolio on the platform, but I wanted to run data. We've completed that. I shared the data. It was a while ago. If you're new, I didn't know. We run a momentum, low volatility, and balance combined momentum, low volatility portfolio. And we did it from 2020 to 2025, 5 years of performance data. And it just crushed. I didn't know that it would. I don't know. It's quantitative. I have a little application that does that. And it did very well on a risk-adjusted basis, on a Sharpe ratio basis, Sharpe ratio of 99 versus a Sharpe ratio over the same period of time for SPY of about 49, I think, 95, 49, something like that. I mean, very, very good data. So do I want to share that? Yes, I do. But we want to make sure we have everything right. And I want to have the data vetted and verified. We ran it. I've shared it with some folks in the industry, and we'll see what happens. But we haven't put it out there because of that. I want to make sure that we have done those things. We do the very best we can. We're a platform for everyone. I'm a Christian, so we try to treat people the way we want to be treated. We try to do our very best all the time, and I don't want to get it wrong. We want to get these things right. So that's all I've got, I think, and I will stop sharing and hand it over to Brian. Brian,
thank you, Tim. If you don't mind, there's a couple of questions perhaps to address before I get started.
Yeah. Let's see. I'm getting there. Thank you, Candace. It is beautiful out there. Yeah. Can you talk about your short, long volatility trade from Monday, Tuesday? Okay. Yes. How I do that? Let me share my desktop again. So what I do, if the market is doing, if we have high supply and declining demand. It's very difficult to trade. I think individual stocks are challenging. It doesn't mean that using the daily trading ideas won't work. But when you've only got 3 or none or 1 or 5, it's not. If there are 20 in this portfolio and demand's rising in the broad market and supply is falling, I will do that all day because you can get a very good, consistent, high probability return. When those conditions don't exist, and it's been difficult for a long time. You go back to the beginning of January and you look at the demand line, over the red line here, and it didn't do a whole lot because supply was pretty low. And then we're here, right here's where I left for the C right here, and I went to cash. Look at the supply side and go, well, I'm certainly not leaving anything exposed to the market. But here's how I do, long short. When it's falling and supply is over 50%, it was flatlining right here. So that's a convergence. If supply is flat and demand is falling, that's convergence. So I'm going to bias my short trade, but I'm going to hedge it. So let's say it's SPXL, SPXU. I'm going to pick the S&P 500 because it's 90% of market cap. It is the safer version. You could say, why not the triple Q? Because it's 100 stocks. Now, it's a lot of market cap, but this is my choice. There could be other things that you can do. And I'm going to call it a, 3/5 ratio. So if if my position is X $1,000 short, then I'm going to bias it to, 3/5 ratio long hedge. And I'll do it at the last 10 minutes of the day. And then when the market opens, if one side or the other is up the full length of volatility, take that side and keep the hedge side. Now your risk, the risk in that is, what if you have an event like yesterday? Now you're not hedged, right? That's the risk. And I don't know that there's anything you could do about that, but this is what I tend to do. So, so I took the profit on my short side, and then you're losing money on the long side, but then the market has a propensity to retrace because all stocks have to trade between the best bid to buy and offer to sell, which will never be the same. The offer will always be the offer to buy will always, let me get it right. The bid to buy will always be lower than the offer to sell, right? So that's how the market works. So then the market is always going to manifest that in some way. It will somewhere retrace. And so it happened, I made money on both sides of the trade, right in a row. That has worked very well. Fortunately, as we begin to get near the green line, I'm not going to bias the trade. It's going to be, that's how I saved myself, actually, equally long and short, because I don't know which direction it's going to go. Right. So then you just let the market tell you, if then it goes off the, okay, well, then I'm going to, I'll take my short gains and keep my long position. But that's what I do routinely. Now, in these situations, I will repeat myself here. It's very difficult to, what would you do if the market moves against you? Well, you lose. That's all, and it gives you the cold sweats. Think about that, right? Yeah. So is there anything at Market Structure Edge that correlates with the tilt? So the bond, that's a good question. So I would say no, really, Martin. Should we? I don't know. We're wholly equity focused, and it's challenging. I have this discussion with my financial advisors who run long-term portfolios all the time. They were telling me, well, shouldn't you reweight? And I said, yeah, but not yet. I'm not going to reweight these things because you don't know which way things are going to go. I got it, Dana. I'm with you. And Karen, my wife, watches all that stuff, and she's like, oh, man, you look at your long-term portfolio, it's really challenging. So no, we don't have anything that meets that. I might be nice. I mean, maybe that's version 3. We'll see. Brian, I'm not giving you much time.
You're good. You're good, Tim. Thank you. Much appreciated. One last question, I guess, when you're doing your long short trades, will you set stop losses on those?
I don't on those. I don't on my leveraged market positions because knowing what I know about market structure, I don't want my order sitting out there for somebody to find, because when you put a stop and a limit in, it's in a pipeline. I mean, it's sitting there. It is what you could call non-displayed liquidity. That's what it is. Displayed liquidity is, here's my marketable trade. I'm trying to buy something. When it's not displayed, it's still there. And there are algorithms. I was on the phone with a State Street trader yesterday when the market did what it was, and he went, I won't repeat it because it was profanity. But he said, I gotta go, because he had an order sitting way outside the market, and wham, part of it got filled. The market moves so fast. So that's the risk that you have. Somebody could come by sweeping through the market. There are all kinds of algorithms designed to do that. I mean, there are hundreds of algorithms, hundreds of order types you can use, like hide, not slide. You hide your order flow, but you don't let it move, so that as the market comes past you, you get filled. Well, that's what a stop or limit will do. Now, it's protection, but it's sitting there, and somebody could trip it, and I don't want to get tripped. I'd like to make that decision myself. So if I have those trades, then I got to pay more attention. And I don't like sitting and watching trades. I don't, when I know what the demand supply balance is and there's nothing going on, there's too much going on right now. There's too much going on. It's not that people are reacting to things. Machines read everything and move the market. And, Citadel is just going to look at it's sifting the bid and offer data. That's what it's doing. And if there are no bids, well, they'll create it and see if things follow. So mental stops. Yeah. I mean, I always think about volatility. So if the market is 6% volatile and I've got a leveraged instrument, I'm thinking about that. I'm thinking, okay, if I get 6% and I get a lot more than that, right? It's like crazy amounts on these things. But you can lose crazy amounts too. So I think always about volatility. What is the overall volatility? And if I'm levered 3 times, the market's moving 6%, market moves 10, 20%, obviously I'm going to take that gain, but it's always volatility always tells me what to expect, right? Because you would say, well, if something moves 20%, it's obscene. It is obscene, but realize the entire basket is moving 7.5%. That is the problem, is both the problem and the opportunity. So yeah, it's a mental stop. That's what I do. If I go, well, I've gotten this, I've got the volatility that I expected, or if the market goes up, the full volatility, the probability that it comes down is very, very high, at least some part of it. And I'll look at that and go, well, I'm keeping my hedge. And you could look at it at times and go, man, I'm down thousands of dollars with my hedge. But yeah, I know that the market has hit the full limit of the volatility. The probability is in the next period of time, and the market tends to move, there's the early morning movement in the market about 11:30 Eastern time tends to be a turning point. I don't know why. Then things happen right up until the last hour of trading, last 30 minutes of trading. Now we're starting to compound toward what will be the reference price for all those instruments that need it. And so I think about that. If I did this today. I had a couple of positions that, again, I said, thank you, God, because it could have been a disaster. It wasn't. But at 10:25, I looked at it Mountain Time. I went, well, it's not a good time. I'll wait until near the 11:30 point. And you see, that's where, and I happen to be on the short side. And that's where the market took another little dip, right? So, and I was out. Like, okay, then just be happy. Just be happy. But that's how I think about it. With individual stocks, stops and limits. If it's down half the volatility, how much is that thing moving? 5%? Okay, so it's down 2.5%. I'm going to put a stop 2.5% below that. It's almost the whole volatility. The probability that it moves its whole volatility under ordinary circumstances is very low. It's basically 8-10% probability. Right? We can calculate those things. Under these conditions, you never know. That's why I steer you away from doing that right now. It's very challenging.
Yeah. Cool. Thank you, Tim.
We should. I chewed up all the time, but you had Brian the last two sessions, so.
Exactly. They had way more of me than they wanted the last two sessions. I'll share just a couple of things. We were talking about intraday volatility. It brings up a good point. I was watching that during the course of trading today. So this is, the S&P 500, and at one point during the day, it had moved lower by about 6%. I shared with you earlier in the note, and I'll try to start doing that when I do the notes. Just, what's the volatility in the market right now? Because I think that's helpful for you to know, if you want to, make these types of trades.
But quick interjection.
This,
I do have that on
yeah,
the programming docket with our chief engineer. So, we
perfect.
intend to have that on there at some fairly near point.
Yeah. What I'm showing you right now is an internal report that we use for our sister company, Modern IR. But what I knew going into today was intraday volatility for the S&P 500 was 7.5%. Like, okay, obviously that's a huge number. Tim had already shared, what it is relative to norms. It's off the charts, right? So knowing that, and actually knowing the big move yesterday, I was thinking about shorting the market yesterday at the end of the day, and I'm like, I don't know what the market's going to do, tomorrow. Would have been the right move, but as we got going in today's trading, I was watching, the broad market over time, and like Tim, I'm doing other things. I'll take a look at this, every 20 or 30 minutes. I'm not glued to the screens, but the market kept moving lower. It kept moving lower, and it got down, 5-6%. And I knew what the intraday volatility was. And to me, there was no new news out there in the market today. So I'm like, okay, I'm going to buy the SPXL. And I bought it, around in here somewhere. And so far, I've sold half of that position. You can see, once again, to Tim's point, midday trading, tends to move a little bit after midday trading. Why is that? It tends to move back towards the average as we get closer to the close. So, perhaps just make a mental note, just kind of like watch that, whether it's individual stocks or whether it's, broad market activity. I had already put this trade on. I was looking at our stocks in our daily trading ideas, and I saw Cooper was, intraday volatility of about 9%. I was thinking of putting on a trade for, I think it's Mr. Cooper, isn't it? Mr. Cooper. This one was down, I don't know what it was. It was down 6 or 7%. So it was way more than half of its intraday volatility. I'd already placed that other trade, so I didn't place this one. But the same thought process was going through my head as I was thinking about, Mr. Cooper from our daily trading ideas. I'll share something with you. I don't know if this is good or not. I'll just be upfront, and I try to be upfront with you as well. Because I'm watching the market and I'm trying to make comparisons. When we started to have the downside last week, it started to remind me of 2020 trading. That was the last time that we saw these types of declines in the market. So this is just a simple comparison, supply and demand, 2020 versus 2025. Take it for what it's worth, okay? But if we look at 2020, as we started to move lower at the beginning of the pandemic, and green is broad market sentiment, that's our algorithm for demand. Blue is the SPY. So predictably, sentiment started to move lower. Notice what was happening here. We had lower moves, we had higher moves, we had lower moves, we had higher moves. It's a very, very common in these types of bear markets or correction markets. One of my clients on the IR side had this to say. He was quoting an analyst. The analyst was saying, "Fast, furious, and prone to failure." That's the up moves, in this type of environment. But look at what had to happen in 2020 for the market to fully recover. We got well below the green line. I think that's probably going to happen again this time. I don't have any proof for that. It's just kind of a gut feeling based off of recent trading activity. We went well below the green line. Very important. Notice what was happening with short volume. Initially, it was moving higher. The market didn't recover until we got significant short covering. We were able to bounce. Obviously, the Fed played into that as well. I mean, back of our heads for this time, what's the Fed going to do? I don't know. I'm not an economist, but to me, it seems like they're between a rock and a hard place. If they're working on this dual mandate, and if they lower rates, what does that do to inflation? I just toss that out there. Like I said, I'm not an economist, but it seems like they're stuck right now, at least to me. This was 2020. Notice what happened. Sentiment had to drop. Short volumes had to drop. Where are we right now? Well, sentiment has just reached the green line. Yes, we're oversold with this type of volatility. We could potentially go well below the green line. Notice what's happened with short volume so far. It's moving sideways. We've not had any significant moves higher or lower. Like I said, I think we need to go significantly lower for the market to start to recover. A couple things that I'm watching as we kind of proceed forward. Obviously, intraday volatility. This, I call it nosebleed levels. The market cannot function well by any stretch of the imagination with 7.5% volatility. That cripples active investors. They can't function in that environment. They go to the sidelines, they sit on their hands, they try to wait it out. It cripples the ETF arbitrage process. It helps fast traders. That's really the only game in town that's going to benefit. How can you play it then? Well, part of it is a little bit of watching, right? For me, as the day progresses, like, okay, what's the market doing today? Tim already mentioned, you in the back of your head, think through, where are we from a big picture perspective? We know that sentiment is sliding. We know that short volumes are high. At some point, we're going to get a bounce from oversold conditions, but how much of a bounce will be sustainable, if we're holding on to those high short volume levels? So kind of like today, I knew what the intraday volatility was. I saw an opportunity with the S&P 500. I took it off, but I saw the S&P 500 lower, and I went ahead and placed that trade. I could have been wrong, absolutely, but I think the odds were stacked a little bit in my favor because the S&P was well below half of its normal intraday volatility at that particular time. As we look ahead, and I'll go ahead and start this discussion, Tim, and please add to it. I'm watching volatility.
And there's a question, Brian.
Yeah,
what would your profit and stops on Coop be? Again, you're aiming for 2%, right? If you could take 2%, you got it.
I'm aiming for 2%. Absolutely.
Yep. Yeah. And realize that's why it's so achievable. If you've got 5% volatility and you're after 2, which is a really nice game for a day. It's really nice.
Yeah.
You have a very high probability. It's just such a better way to me than thinking about, what's the right price level, or what's resistance and support. Yeah, exactly. Stop it too, right?
And the earlier trade I placed on SPXL, I took half my profits. That was at about 6%. I don't know what it's doing right now. But with those leverage trades, if you get them right, you stand the potential of making a lot more money on those. In fact, over the last few days, I think it's 4 out of the last 5 days, I've made money buying volatility, just that UVXY trade. So it's that type of environment. If volatility is off the charts, well, that's what you trade, and you just watch both sides of it, and you look for when it gets out in front of its skis, one way or the other, and then you go the opposite direction. So that's kind of, from a trading perspective. What I'm watching as we go ahead, and we already mentioned part of this, volatility. I'm watching for short covering across the market, options expirations next week. I think I have the chart up. So this is on Market Structure Edge. You can find this, but April expirations is going to be a little bit different because next Friday is Good Friday, market holiday. So the 16th is going to be VIX expirations, and it's also going to be AM settled expirations. So next week's going to be different. It's going to be condensed, and then the PM expirations are going to be next Thursday, the 17th. So just be aware of that. And also be aware, the closer that we get to expirations, the greater the opportunity in the market. If there are rights to shares that have just been decimated, uh, you have an opportunity for hedge funds to potentially swoop in, pick up inexpensive rights to shares, drive them up over a day or two, sell them real quick, and boom, they've made 30, 40, 50% on that trade. So I don't know if that will happen or not, but just be aware that that potential is out there. I think that was it for me, Tim. I'm not sure if I missed anything or not.
I've got one thing that I'll mention. Kara, I'm just answering your question here. Doing this one. So Kara, yeah, I don't like to. I mean, time is risk. What we're trying to do, if you're risk adjusting your returns, the least period of time that your money is exposed to the market is the best. Citadel takes the least risk because its investment horizon. I'm picking on Citadel, 400 milliseconds. I mean, if that's your investment horizon, you're never exposed to risk, but you have to have the data and the machinery to have that kind of horizon. We can't. They will destroy us if we tried to compete with them. Can't do it because they buy all the proprietary data feeds. They literally have servers in 220 markets. They know every single thing about every security, right? So you can't compete with that. But they start over every day, right? So that's why I like to do right at the end of the day and say, well, what happens overnight? The futures contracts are constructed right there, right? I'm going to get the reference price. So whoever did it is going to be hedged. So I don't worry about that in fact, that's the opportunity, right? I'm hoping I get movement overnight so that I can immediately at the open get rid of it. That's what I like to do, Kara. It doesn't always work that way. Sometimes I will keep a levered position for a couple of days. If I look at the data and say, and the market's not doing what the data indicate, what is the probability that it will? Well, in 1 to 5 days, very, very high. I mean, we can run a 99% correlation model to SPY prices. We can predict it that well. So, but 10 days, we can't predict it. Our ability to predict something falls by half in that period of time. Run it longer than that, 30% correlation. So, but 5 days, I will hold a levered position, but the problem is each day those are reconstituted. So if the futures contracts supporting it are reconstituted, could be at a different value. And so it deteriorates very rapidly, kind of like options, right? The biggest thing with options is time decay. Same thing with a levered position. Every day it's decaying on you and reducing the probability of return. So you want to have it out as much as possible. A levered instrument that you bought 10 minutes before the close should be out before 10 minutes into the close because it's going to get reconstituted. So knowing that, use it to your advantage. One last thing that I wanted to point out is, and Brian, you were going to do this, and I know you trimmed it out for time, is SPY. So SPY, only ETF on the platform again. This is the 5-year view, and it really tells you where we are. When you get this happening, you should start to think. This didn't happen to be very big, and that was 2019. I think we had a currency issue. We had the overnight market froze up, and the overnight rate jumped to like 10%, but it never got to 1. So you look at those, well, that's not terrible, and you could know that going through that. If SPY did not dip to 1, probably not that bad. If it does dip to 1, beware, right? That is the beginning of things. That's exactly what we calculated, right? We went, holy cow, look at this. The amount of time that it's been at 1 is the worst in the entire data set. Does that mean this will be the worst in the entire data set? Could be. I'm not saying it's going to be. I don't know what's going to happen. No, we don't know the future. We only know the past and what effect it might have on the future. But look at this. So are we here or are we here? I don't know, but we haven't had that, right? Here, this is that to me, which means this could get a lot worse. I'm not, again, I don't know what's going to happen. Something could change the tenor of the market. Absolutely could. And all the data will change. These conditions always assume that what is occurring continues to occur. And something can change it. A Trump tweet could change it, right? I don't know. Nothing really fundamentally changed at all yesterday or today. The tariffs are delayed 90 days. Yeah, but nothing changed. Fundamentals, nothing changed. So what you have to think about is, what are the flows doing? If the flows don't change, this is going to get worse. Now, again, we're just going to watch the data and see how it unfolds. If you look at broad sentiment, which is now moving to the basket, that's the derivative. It's not predictive. It only tells you what the conditions are. This is predictive. This would tell us, well, there's a chance that we're at a bottom. But what if it goes a lot further lower, as Brian said, right? We don't know. We don't know what it's going to do. It was very interesting to me that this, I pointed this out. This was the steepest drop for sentiment since 2022. So you look and go, whoa, that's probably not good. It was an opportunity to buy briefly, and you could, for your longer term accounts, it worked just fine. Maybe, here when demand jumps above the red line, take some money off the table, and you wait for the next entry point. Okay, well, I'll put some money back in. But as soon as it gets to the, over the red line right here, well, you can't protect yourself perfectly, but you can have a pretty good idea. So what's going to happen? I do not know. We're at an entry point, but that's how I would describe it. So just, these things now. So let this, shape your behavior. You know that the market is at this potential turning point, except that it could get worse. You go all the way back in the data set, and I'll finish with this. You want to look at what were the steepest demand declines. Weak demand weighs on the market. We've had weak demand for quite an extensive period of time here, and it's not loading for some reason. Oh, there we go. So you go all the way back here. You go back and look at the low points for demand. And it really has to hit a nadir for the market to recover. Maybe even has to do it twice. You can say, well, is that a double bottom? You can apply some technical term to it if you want to. I look at this and say, we are just early in this. Now, again, I'll say, I don't know. We had this huge short covering event. Now here's where we are. We've had one steep dip. Do we have a number more coming? Again, you just don't know. But it's very helpful to have this kind of perspective to me. I think it's a unique capacity that this kind of quantitative analysis can give you. It really does give you a great lens on what everybody is doing, because it reflects all motivations. Quantitative, short-term, long-term, fundamental, monetary, fiscal, economic. It's all factored into what everybody does. We're just watching what everybody does. That's it. Okay. That's plenty for today. We'll look forward to seeing you next week. I'll be here, I think, so far as I know, and I'll look forward to seeing you then. Thanks for joining.